point about some of the potential impacts on house prices from changes by regulators, and I know APRA's asked everybody to tighten their lending assessment criteria, and I believe they've circulated a paper recently asking banks, what the effect of some other macroprudential controls might be. I think that's an interesting segue into how being a subsidiary of Bendigo and Adelaide Bank can help give you a different lens on the credit world, because we were talking before the podcast that you actually have the ability to sit down with the bank's credit team and workshop how some of these changes affect what they're doing, which then gives you some ideas of how it might affect the the asset-backed securities that you're looking at in your portfolio. So tell us a little bit about how those sorts of conversations can improve your understanding of the market and what's happening.
Yeah, for sure. It is an interesting one, and we certainly often get questions about do we invest in the bank? Do they shove assets in us that they don't want? That kind of thing. And I think it's there's been some bad behaviours by some in the past, and I'm very comfortable and proud to work for Bendigo Bank, who certainly doesn't have the reputation to do that, and doesn't do it. We don't invest very much at all in RMBS or FRNs issued by Bendigo Bank, and I think we've got no exposure today. Now we can take some exposure, but we do that again quite opportunistically. But in terms of, it's really interesting when you have access to the chief credit officer, you have access to the head of capital, and the regulatory compliance department, which obviously that kind of stuff's really big in a bank, because it does give you a good I can sit down with those people and get a good sense of what are they thinking, how's their first response going to be to a new regulatory change or those kinds of things. Because I think the whole industry hears about every move APRA would make and the Reserve Bank, and there's always a quick response from the sell side on what does this mean for banks. But my observation is that that's not always the sort of operating, living, practical truth. An example I can give you is, and perhaps one that really helped us if we turn the clock back to the Royal Commission, that bizarrely some people have forgotten about already. But I guess COVID's been a pretty big deal. But if you turn the clocks back to the Royal Commission, perhaps you and I and many were watching those each day, with some really tough questioning on some bank executives and senior managers. And one of the things that we sort of picked up, and I had a good chat with the head of risk and then the head of credit here at the bank about pretty early on in the in that Royal Commission, was the responsible lending, and really the call out that it hadn't been applied correctly and appropriately, and maybe there was compensation. And I think the market kind of saw that and thought, banks have not been responsible and kind and fair, and all right, there'll be a little bit of remediation cost. All right, great. And that was the kind of stuff you heard from the sell side desks. But when I spoke to credit and head of risk, the attitude response was, well, we have to move people off of this sort of model of what they're going to spend onto what do they actually spend. And when you do that, it's not very hard if you understand these models, to pretty quickly learn that people's borrowing capacity is a lot lower in that kind of situation. And that's because these models don't include things like private schools. They don't include holidays other than, really basic holidays. And so they have very limited amount for entertainment, which obviously a lot of Australians spend a decent amount of money on entertainment. So When you look at this, quite simplistically, we worked out that borrowing capacity of the average Australian was going to halve very quickly, and the other thing I could read the media and the notes from in the media articles and the responses of the major banks in the context of these conversations I'd had told me when Westpac, CommBank, ANZ, etc., were literally cutting their spending models for every single Australian. The response for us was easy. It was to focus on the collateral quality, because we sort of looked at that situation and saw house prices were going to probably fall. We didn't really know how much, but certainly that the rug would be pulled out from under them because of lending capacity in the community. And the places that would be worst hit were the most expensive properties. So Sydney, inner city Melbourne, and parts of Queensland as well, where some of the highest priced houses are. And so we spent the time, were able to, in a reasonably orderly way, consider our RMBS investments, what exposures we had. We made some divestments. We actually added exposure in some people that we thought were reasonably immune. But it gave us a different conversation to go and have with those issuers as well, those non-bank issuers, like AFG and the like, and talk about what were their practices. Where were they going to stand on this equation and issue of responsible lending? And it really gave us a good, clear sense of the people that were already running pretty conservative credit underwriting versus those that were more aggressive. And we kind of were thinking about where's the possible lawsuits, but then it was more about if people were using all of their capacity to buy the properties in a pool, then those properties were the most vulnerable to a decline. And so the quality of your collateral and bringing that into your equation. And again, that's a bit of a top-down kind of activity as well, though it's not so economic, if I can put it that way. But yeah, so we see a lot of value in getting the bank's perspective. There's always changes to capital rules. You're right. At the moment, macroprudential is certainly being discussed, and I think sometimes we get just a little bit more flavour on what is the regulatory strength behind a move, which you don't always get from the consensus view.
So all in all, it sounds like a very useful input into your investment process, really understanding the world that you operate in.
It certainly creates a bit of leverage. And given like with these funds, you're investing in bank, FRNs, bonds, and you're investing in RMBS, it's all sort of mostly boils down to residential property risk. And so it is, from that perspective, it is, great leverage for my team. We're not tiny, but we're not enormous, and we just get so much value out of some of those conversations in that kind of particular area from the bigger organisation.
I guess you can also benchmark too what you're seeing from the issuers, because the issuers might be saying they see the world this way, and then you can ask your peers, how are you seeing it from your end? And it gives you a basis of comparison to see who's, as you say, perhaps being a little bit too sharp with their underwriting and not as thoughtful as they might need to be.
Sometimes as well, you speak to the in-house legal and on an issue, and so one that's just coming to mind now is self-managed super fund lending. It's one of those things that's there's two camps, and there's not many people in between those two camps. Some people think it's terrible, highly risky, and other things fantastic. But it's really good to speak to people who've done some work and where are the pitfalls, where are the opportunities, and then use that, take that when we're looking at a pool where there might be a bit of SMSF lending, and really challenge, show me and talk to me about what's involved here in the application process. You say to me that, we make sure it's relevant, that it's appropriate for the investment strategy of the SMSF. But how do you do that? Show me your documentation and your evidence point, which I think that quite often people like they take the first response and they're sort of like, yep, tick, that risk's being addressed. When you can talk to people that have done the activity at the front line, and you can trust their responses, frankly, you're right, it really creates really good benchmarking.
Podcast is for informational purposes only. It does not constitute financial advice or take into account the particular investment objectives, financial situations, or needs of individual listeners. Listeners should consider whether any opinions or recommendations in this podcast are suitable for their particular circumstances and, if appropriate, seek professional advice, including tax advice.